Hello, good afternoon, everybody. This is Eric Showalter. I'm the founder and owner of Arbor Private Wealth, a registered investment advisor in Ashburn, Virginia. We're approaching our third anniversary in 14 days. Today, I've invited Apollo Lupescu. He is a PhD from University of California at Santa Barbara. He's been with Dimensional Fund Advisors for over 20 years. He serves as a vice president, and he frequently meets with clients and helps them understand issues that are relevant to the investment industry and current. So with that, I would like to turn this over to Apollo. If you want to say some more things about yourself, please, I'd appreciate it.
Well, first of all, Eric, thanks so much for the invitation, and thanks to all of you for joining. And it is a topic that is so hot right now. So I'm so glad that you're doing this because it is on people's minds, and it's something that I think it's only going to get hotter. So getting some perspectives before we really get into the heat of the matters, I think is hugely important. And just about myself, I have been in the investment business for over 25 years. I've been with Dimensional for over 20 years. And one of the things that I really would like today to do is not necessarily have a monologue, but have a dialogue. And if you have any questions, please go ahead and put them in the Q&A box, and we'll try to get to as many of those as possible. So the more we can have a conversation around what's going on in the world, the politics, the markets, and so forth, I think the better off we'll be. But just myself, I'm more of a believer in making things understandable rather than just blow people's minds with jargon and things that nobody really can get. So like, just how do we make things intuitive, make some sense out of all the noise that exists out there? Because there's a lot of noise that's happening right now with respect to the election and everything else out there. And there's a way to, cut through that noise and give some clarity to investors.
So on the call, if we want to call this a call, we've got folks on the West Coast, California and Seattle. We've got folks on the East Coast, New Hampshire, New York, Florida. We've got folks in Florida. We've got folks in Kentucky. We've got folks in Michigan. So a limited number of people across the geographical spectrum, and also across the political spectrum, and that's good too. Let me say this. Let me pick my first question, if I could, and I'm just gonna go for the jugular. Does the stock market care which party is in power?
So let's start with and I'll give you the short answer is that the stock market absolutely is paying attention to the election and who might win and what the policies are. The next question is, what is the magnitude of the impact? And that's what we're going to get to for the rest of the session is, it's not the markets are oblivious. Of course, politics matter. Of course, elections matter, policies and whatever. The question is, to what degree do they have a significant impact on the market, or is more marginal? And that's what we're going to try to address this whole session. But, Eric, I'm so glad that he brought up the variety of geographic locations and the fact that people are all over the place, not only geographically, but in terms of their political views. Because over the past few months, I have really traveled the country, not just necessarily by Zoom, but being in person at events anywhere from the Deep South to Northern California to you name it, New York and so forth. And one thing that I've observed is that there's quite a bit of anxiety around this election. And it's not only in one particular geographical area or one particular liberal or conservative area. It's pretty much generalized around the country. And in some parts, the anxiety could be around, what if we have an autocratic government and we don't have the same democracy that we used to have? And in other parts, it might be, what if we have a communist regime coming in and all of a sudden the government is going to tell us what to do and take away our freedoms? So I think that there are different anxieties, but they're both anxieties. And I think it's important to acknowledge that because people do feel apprehensive about the election because of these emotions. And it's absolutely true, Eric, that politics and elections, they do touch our deeply held beliefs, our core identity as individuals. And because of that, they trigger these emotions. And I don't think there's anything wrong to have these emotions. It might not be pleasant to have this anxiety, which is a form of an emotion. I just think that any successful investor that I've met acknowledges this emotion and at the same time is able to somehow disentangle it from investment decisions about their money, and make those decisions based on much more pragmatic reasons, such as what does the data suggest? What is the evidence around that? And make investment decisions and make money decisions based on the data rather than the emotion of how they feel. And I do think it's an important place to start, because quite often what I found is that the emotion might not always be aligned with what the data suggests. And I found this over and over, that quite often there is a narrative that people have. And when you look at the numbers, they're actually quite different. The emotion, how we feel versus what the data suggests, is vastly different. So to answer your questions, investors are paying attention to this. It certainly impacts the market. The big question that we'll try to address for the rest of the webinar is, to what degree? What is the magnitude of the impact? And does it mean that the magnitude is big enough that you ought to make a move with your money? Or is the magnitude small enough where you shouldn't change course from where you are right now? So let's start with that. Okay, so let's look at the in order to answer that question, Eric, I think that the fundamental premise here is that the stock market, which I don't believe is the best way to express it, because stock market has a pretty bad connotation in people's minds. I think a better way to think of the stock market is an ownership market, where you can buy and sell ownership in companies that you did not start. I had nothing to do with Microsoft. I'm not connected to Bill Gates at all. And yet I can go buy a piece of Microsoft and be entitled to part of the earnings and the profits that Microsoft makes, pretty much like Bill Gates. Not as much as he has, but still conceptually I have the same rights to earnings commensurate to my ownership. And I think that is incredibly powerful, because it gives us all a stake in capitalism. In that respect, what this ownership market, which is called the stock market, what it's really trying to do every single day is assess how much is this piece of ownership worth it. So when you look at the price per share of a company, that's what it basically reflects. If you own a piece of that company, how much should you pay for that ownership? And it turns out that that value fluctuates all the time based on new information. And politics certainly creates new information. So every single day, every single second, this ownership market adjusts the value of ownership based on what do we expect that company to make in earnings and profits for years and years to go, because you are entitled to these earnings for years and years ahead. That's what the function of the market is. So then what the market is really doing in a very cold way is asking, what is the impact of these policies that an administration might have on the future earnings of a company? And how significant is that? So the different ways that we can look at that. And I'm going to start with just an illustration of that point. And to understand how the market's doing this, there are two things that you want to keep in mind. The first one is that for the most part, the markets are comprised of very sophisticated investors, people who are paying attention to what's going on in the world. And if there's certain expectations come about for policy changes, for whatever the case might be, good or bad, the markets are incredibly quick at pricing that in, which means that if I expect a policy, if there's a really realistic expectation of a policy that's going to benefit a company, what you see is that the price of that company will move up even before the policy is implemented. And I'll give you some examples of that. So clearly, the markets are what's called forward-looking. They price in an expectation of a policy before the policy gets even implemented. And secondly, it's not that just the markets are what's called efficient and very good at pricing that in very, very quickly, but secondly, you have to analyze this not at an industry level, but more at a company level. And I'll share some examples with you. So what I mean by that, let's just make it real, because this has been very abstract. So let's go to the previous administration, and this is rewind the tape to January of 2017. And as the previous administration came in, at some point not long after, there was a talk of perhaps supporting domestic manufacturing industry, and more specifically steel. And it turns out there's a company that actually carries the name of the industry. It's called United States Steel Corporation. And it's a company that is publicly traded, meaning that all of us can go and buy and sell ownership.
They're in the news again today, right?
They're in the news again today. But let's go back to 2017. Because as the year started, that company, if you look at the price per share, it wasn't doing phenomenally well. It dropped for a variety of reasons, whatever might have happened at the time. But that's when the conversation started that perhaps the government will get behind the U.S. steel industry, and they'll perhaps impose some tariffs. And there was an expectation of tariffs. There's no clarity that we're going to do that, because there are a lot of considerations when it came to that. But there was certainly an expectation. And what you see is that perhaps one of the reasons that this price started going up and up and up is in the expectations that tariffs might come. And tariffs means that the U.S. Steel would have a huge leg up in sales, because the other companies abroad would have to pay a tariff.
The tariffs are applied to their competitors.
Exactly right, to competitors. So that gives them a absolute, thank you, absolutely. Now, the thing is, there was no clarity if this is going to happen or not. And as it turns out, in March of 2018, those tariffs did get announced. So the markets, you're going to see that it had an expectation that it was pricing in that perhaps these tariffs would come in, and the stock price did go up. And that's when people said, aha, now we have the backing of the U.S. government, and this ought to be good for investors. So if you get to that, caught up in that seductive narrative that, oh, these government policies are going to help me, well, then it seems like the obvious thing is like, let's go buy U.S. Steel in terms of that stock, because it is supported by tariffs by the U.S. government. It's got the full backing of the federal government behind it. So what if you had adopted that strategy and you actually bought ownership in U.S. Steel? Well, by the end of the administration, by the time of the future election, it turns out that it lost the vast majority of its value. It would have been a disaster from an investment perspective to follow that seductive narrative that, hey, I should buy it because now it's supported by the government. It just doesn't appear to be the case. Is it that the tariffs didn't help? The tariffs helped, but they built up the stock price in expectation of the tariffs. Once the tariffs were priced in, from that point, it probably had a lot more to do with the products, the strategy, how they executed, much more so than the tariffs itself and the government support. So just because the government gets behind an industry, there's no guarantee of success. Now, that's the previous administration. The current administration made a point to support green energy, sustainable energy. So green became big. And in fact, solar panels were a big part of that. And I remember that a few years ago, actually in 2021, I was looking myself to perhaps put some solar panels on my house. And as I looked at that, I was like, well, what companies did I go research at the time to put solar panels rather than to invest in? And one of them was this company called First Solar. So as I look back recently, what's interesting is that the price per share, the value of First Solar, over the course of the last 3.5 years of the current administration, it pretty much doubled. So First Solar, in 3.5 years, you would have doubled your money, which is like, wow, that's a really nice outcome for an investor. And perhaps kind of having the government policies behind it really helped. Not just necessarily in the beginning, but throughout over the course of this 3.5 years of the current administration.
Okay, that's
at the same time,
3x over the past 3.5 years. Is that what you said?
2x
over the past 3.5 years. Okay,
exactly right. So you would have more than doubled your money over this 3.5 period. But what's interesting is that when I was looking to put those panels, I was being a little smart to try to do some comparison shopping. And I looked at what are the companies that I looked at, and one of them was a competitor of First Solar, and it's still a solar panel company. It's called Sunrun. And what's interesting is that even though the price per share of Sunrun was trading roughly the same price in 2021, by the end of August, Sunrun basically lost about 75% of its value. 75% down over the same exact time period, even though it's in exactly the same business. It's exactly the same business, solar panels. It wasn't a recipe for success for every company. And that was the point that I was making earlier, that it really depends on the strategy, how they execute it and all that. And it turns out that Full Solar was able to do a lot better than Sunrun. And at the same time, I thought, okay, well, this is green energy, but what if you actually didn't pay attention to this and he just really said, well, I'm going to stick to the good old-fashioned fossil fuel, and in that case, you wouldn't have been bothered by the fact that fossil fuel doesn't have a lot of friends in DC, and you would have decided to maybe buy ExxonMobil, which again didn't have a lot of friends in DC, arguably because of the legacy fuel. Well, it turns out that the stock price of ExxonMobil from the time to the end of August more than tripled over the same exact time. So again, does it mean that it should have overloaded on solar and not on fossil fuel? Again, it didn't seem to make much of a difference, even if fossil fuel did not have friends in DC. And within the same industry had winners and losers. So again, it comes back to this idea that politics and elections and all these policies, they do tend to impact individual companies. It's just they don't seem to have like a clear outcome that industry support or not, a policy comes in or not, and that's gonna make the particular stock go up or down. It just doesn't appear to be the case. It seems like it's a little more complicated than that.
If you step back from the individual companies and look instead at the sector level,
yeah,
is there more of a predictable trend, even if it's a less significant change?
Yeah, and
is there a tendency in these sectors that would be an opportunity, even if within those sectors you've got winners and losers?
Absolutely. And we looked at that as well. No, there's nothing like that to show that any one particular industry, whether it's supported, whether it's not, that they would have a clear advantage. Because so much of what might drive an industry, might come after policies or after government comes in. So just to give an example,
Okay.
Not sure that I don't want to oversimplify and explain that the whole reason that ExxonMobil did well is because of one reason or another. It's just that it's not counterintuitive to think that as the administration came in about a year later, it's actually pretty much exactly a year later, Russians decided to invade Ukraine, and they started a war in Ukraine, and they devastated that country, which is horrible. And when that happened, the Russian oil just became out of commission for the market. So at that point, the price of oil went up, and that had nothing to do with the administration. It was just the market forces looking at how supply and demand was realigned around the world. So to me, again, it's something that is, even if you look at the sector level, there are going to be other dynamics rather than the policies coming from DC. They're going to drive that. Solar panels. You look at solar panels, and a lot of it had to do with the oversupply from China, and then you have the tariffs. But even then, it's very complicated. That's kind of the point. And to kind of try to oversimplify it, and it's just not a good way, because whatever the government does, it's a one-time change in price. The market doesn't keep drilling on that, and just doesn't take forever to kind of price it in. It's a very quick price in, and we're going to the next thing. What is the next thing that might impact the industry, which might not have anything to do with the government? That's kind of the point.
So I think globally, almost 40% of the publicly traded stocks are international.
Correct. Yes. So if you look at
international stocks, even I assume, are impacted even less.
Yeah. So basically, the same way that any company can be based in Florida or California or Vermont, you name it. It's the same that a company can be based all over the world, and then different companies, as they're based in different parts of the world, they are associated with one stock market or another. And in fact, if you redraw a world map, and instead of landmass, you were to plot the value of all companies that can be bought and sold around the world, this is what that map will look like. The US is the largest stock market. There are about 3,400 different companies in which you can buy and sell ownership, starting with Apple, Microsoft, got McDonald's, Coca-Cola, you have Shake Shack and so forth. And that's about 61%. To the point that he made, it's exactly pretty much 60%, 61% is in US companies. The rest of the world is about 39%. So they're just, roughly about 40%. And the second largest stock market is Japan. And there are about 2,500 different companies. And even as they have 2,500 different companies, their value combined is not that great. It's only about 6%. You look at the Chinese stock market, where the economy is huge, but in terms of an investor, in terms of what's available to an investor, China is pretty much the same value as Apple. The entire Chinese stock market is not vastly different than Apple. But I also want to kind of like take one more note at this, Eric, is that when you are investing in these markets abroad, you're not really investing in countries. You are investing in companies. Mm-hmm. And I think this is a really important distinction, because if you look, for example, and say, I want to invest in the US, if you look at the car industry, for example, then you would buy ownership in companies like Ford, GM, Tesla, and that's great. You own a piece of these great American companies. But it turns out that if you go on the streets of pretty much any city, you'd also find some Beamers, you'd find some BMWs, some Porsches, some VWs. And then, those are also cars that we buy here. And even great American brands like Jeep and Chrysler, they're owned by an Italian company that trades in Milan, Stellantis. So that's international investing. You have the Japanese car companies, the Hondas, the Toyotas, and so forth. And those are certainly familiar to us. British brands like Land Rover and Jaguar, they're owned by an Indian company that trades in India. Volvo, my daughter drives a Volvo. That company tends to be owned by a Chinese company. And in fact, the largest manufacturer of electric cars these days is a company called BYD, in which Warren Buffett invested over 10 years ago. And now it's, again, the largest seller of electric vehicles, more than Tesla. And then you have the Korean shops also making inroads. So in a way, the way you want to think about it is that if it makes sense to own Ford and GM, perhaps it's also worth considering BMW, Toyota, and Jeep for that matter, because that is international investing. Anyway, so that was a good question. I appreciated the question, because it is a global marketplace. You cannot just focus only on the US.
But back to that, the relationship between investment performance and the elections. I think we just said that within the US market, not much of a relationship, and I'm assuming international the same.
Absolutely, it's the same, because what happens most often, Eric, is that the fundamental premise that drives the U.S. market as well as foreign markets is capitalism, and capitalism means free markets. As long as companies are allowed to operate in free markets, they will try to find a way to make money. Mm-hmm. And they'll try to figure out a way to navigate whatever is put ahead of them, and that's just the reality. And in some ways, that's manifested whatever the company might be based, because very few companies today sell only in one country. I mean, the majority of companies, particularly the meaningful ones, they are global in nature, and whether they're based in the U.S. or abroad. As long as free markets are not disrupted, it's basically the politics and elections want to have a huge impact.
Okay. So you started with an example of imposing tariffs on the competitors of U.S. Steel. When you look at this election cycle,
yes,
are there two or three policy issues on the table that the investment community is most focused on at the moment?
I don't believe that that's something that came out that is a clear. No, I don't know that there are some universally accepted set of policies or suggestions of policies or proposals that are everybody in the industry is focused on. I think that what's going on at the moment is that people are concerned about a set of issues like estate planning and taxation and so forth.
Capital gains tax.
Capital gains tax and so forth. And I don't believe that at this point, these are fundamental drivers of the stock market. And I don't believe they will become fundamental drivers of the stock market. So let me explain why. If you look at taxation, corporate taxes, for example, what we've seen over the years is that tax rates change. And particularly large corporations that are part of this ownership market called the stock market, over the years, what they've done is a really good job of trying to navigate whatever changes in taxations might happen. 20 plus years ago, when I was in the PhD program, I was offered a job, and it was in an area called transfer pricing. And what it basically meant is that a company, let's call it company ABC, they take their logo and they give it to a subsidiary that is based in some other country with a lower tax rate. And what they do then is they license back the logo from that subsidiary, but in the process, they pay all the money to that subsidiary, which is in a country with a lower tax rate. In other words, for many, many years, companies have figured out a way to negotiate these tax rates, whatever the case might be. Over the years, again, there are stories of how little or whatever tax regime we have that large companies have paid, and I don't think that's going to change. I don't think that the companies fundamentally will just cease to look for those opportunities. They'll just basically navigate and figure out what to do next. And again, it comes back to the earnings and the profits of the company. That's going to be the primary driver. And otherwise, they're going to figure out these things on the margin of how do we negotiate taxes. But I don't believe that's going to be a primary driver of the market. And there'll be a couple of other examples that I'll give you as we go along to show that is not the primary driver. When you think about the estate planning tax, you hear a lot about the estate planning tax as being an issue. How is the estate planning tax impacting the profits and the earnings of NVIDIA? It has to do with you, and you have to be careful in how you plan for that. And there are ways that you can plan for that. But in terms of how it impacts the corporate profits, I'm not sure that anybody at NVIDIA is going to, well, we're not going to make as much money because there's this corporate, there's a estate planning tax. So it is not a driver of the market as much as people want to think it is. It's just not a driver of the market because it doesn't impact the corporate earnings. It's not a variable that impacts the corporate earnings of any one company.
Yeah, the question that I got recently was back to the capital gains. I think the discussion about taxation of unrealized capital gains, which I think applies only to people that make more than $1 million a year. But even with that group, apparently there's a meaningful number of people that earn over $1 million a year. If those folks were forced to sell their equities to pay the tax on the unrealized gain, would that increase in transactions have a meaningful effect? And I got to think that portion of the market is pretty small and would not have that meaning.
Absolutely. And I think the logistics of that are just, in my opinion, impossible to overcome, to make a practical law out of it. Because if you are, let's say, I'm going to use just a name, Mark. If you're Mark and your holdings are at $9 billion, and that's exactly like, let's say you're $10 billion, and that's not a terribly disconnected from reality example that a few years ago, if you had $10 billion and if you're Mark Zuckerberg and you own a piece of Facebook, Facebook dropped about 60+% in any 1 year. So let's say now instead of 10 billion, you have 4 billion. Well,
Yeah.
if you're being asked to pay tax on 10 billion, but what
Right.
she's worth today is only
That-
4, you can even pay the tax on that,
Right,
even
right,
if you
right.
sell everything. So I
Yeah,
don't think that's something that
that's right.
necessarily will happen, or at least in that format. And even though there are, there might be other forms that might come in. I just don't think that there is a logistically viable way. So I'm not sure that necessarily would have a huge impact. And once again, the markets are really good at forming an expectation. If they think that's a real clean expectation that that's going to happen, that's going to be priced in way before this law is enacted, and by then it'll be too late. But at this point, the market's not really assigning a high probability to that particular event.
Yeah. Let me turn it a little bit. Ever since, for as long as I've been alive, the federal government has spent more than it's collected in revenues, and for as long as I can remember, which goes back to I can remember until back to about the mid-70s, just to put it in perspective. But the budget deficit has been a priority for voters and investors alike. How do you think about deficit spending, or maybe I should rephrase it. How do you think about total debt? And you can choose how you want to answer it, but how do you think about those two in the context of what level is a healthy level, or you could even reframe it to what level is tolerable or healthy enough? And if I asked it a different way, if we could go back in time and make different fiscal decisions, what would make my 401k balance higher or lower?
Yeah, and it's such an important question, because it has kind of multiple facets to your point. There are 4 different facets. I think the first facet is how is this debt impacting the stock market, and should I make a decision based on that? The second one is, what about the economic impact of this on all of us as citizens of the country? And then how are the markets assessing how sustainable this is? And you can go further. It's like, well,
You went on mute. I think you just clicked mute. Can you hear me, Apollo? I believe you are on mute.
Oh, can you hear me now?
I can hear you now. Yes.
Yeah. Sorry about that. I think my mic just decided to stop working for a second. I had to switch mics. All right. So there are different facets to this. I don't know where I kind of cut off, but there's one that involves, how is this impacting the markets, the stock market? Should I make a different decision with my money? The second one could be around how is this impacting, how are investors assessing if this is sustainable or not? What's the economic impact on all of us? So let's just have a few minutes on this particular topic, because I think it's very, very current and very important. To begin with, let's just put some numbers. As of the beginning of this year, us as a country, we owed at a federal level at the beginning of 2024, roughly about $34 trillion. That's the number, $34 trillion. That's how much we owe as a country. And to get some perspective, if you look in 1990s, in 1991, for example, roughly around that time, that number stood at about $4 trillion. So over the course of the last 30 plus years, we have increased our debt 8-fold. And that's where a lot of people are saying, well, this is a lot of money that we owe. And there's no doubt in my mind that's a lot of money. Now, the way that the government borrows money today is not by going to a bank, but rather they come to us investors and say, listen, Eric, why don't you lend me $1,000? We'll write up a contract, and we'll specify in that contract how many years or how long will I give you an interest payment on your money, and then I will give you the money back, and we call it a day. That's called a bond. That's how the government borrows. And it turns out that the government has the ability to come to me and say, listen, hey, do you want to lend me $1,000? And if I agree to that contract, then they can take my money, give it to Eric, and in effect,
push this principle back down the road. And whether that's right or wrong, it's something that the government can do. It has been doing. Now, in that respect, it seems like you can push that out and you can avoid it to some degree. But there's one thing that the government cannot avoid. They cannot get away with something, and that is paying interest on that debt.
Mhm.
That to me is the true cost of the debt, which is how much does it cost us as a country to pay interest on that debt. That is a true cost, in my opinion, of the debt. And what you want to do is make that cost of interest relative to something, in this case, to the size of the US economy. And if you go back to 1990, it turns out that we paid about 3.1% of the value of the entire economic activity of the country in interest payments. That was the percentage that we paid as the overall value of the economy in interest payments in 1990. Well, today we don't owe $4 trillion, we owe $34 trillion. So what is the percentage today? And it turns out that the Federal Reserve keeps track of this number, and it's published. I'll share you the website in a minute. But as of the end of last year, that number was 2.4%. It was actually lower. It was actually lower for 2024, for 2023 than 1990s. How come? I mean, what's going on there? And by the way, this is
even with the higher rates. I mean, am I thinking about that right?
And I'll come back to that. You're absolutely right.
Was the interest expense impacted by higher rates, or the higher rates only affect future interest rates?
Exactly. So the interest payments have two basically variables. One is, what is the interest rate that you pay? And then second, what's the level of the debt?
Yeah.
And even though the level of the debt in 1991 wasn't as great, the rates are much, much higher. And there's a third variable that I'll mention in a second. But as you see here, from there, it starts going down and down and down. And even if you go back to 2021, this is like 3 years ago, even after we borrowed after the financial crisis and the pandemic, that was still 1.5%. It was still half of what it was in the 1990s. And it's been the last 2 years that we've seen this increase. So what's going on there? And the answer is exactly what you mentioned, is that the majority of this debt, about 25 trillion or so, was borrowed since the financial crisis. And that was incredibly low rates that benefited all of us. And as the government has to refinance now at a higher rate, that's what you saw, that line going up. Now, what's going to happen down the road? It depends on how the rates move. If the rates are going to stay high, that's going to make it more expensive, and that percentage might climb. If the rates go back down, that's once again you might see the line coming back down. But the second thing to note, folks, is that you look at these numbers and you say, wow, we just been borrowing a lot of money. The reality is that everything went up over time. The economy is a lot bigger today than it was 30 plus years ago. And just to kind of give you an idea, if you look at the stock market as a whole in the US, back in 1990, the value was about $4 trillion for the stock market. Today, it is roughly around $40 trillion for the US stock market. So it went up tenfold. So the fact that things go up in value, it's not something that is completely unexpected. That the fact that we saw the deficit, we have more people in the country, the economy is bigger, the stock market's 10 times bigger than it was. So it's not unreasonable to say that, yeah, we owe more money. It's not like, wow, it's necessarily subject to panic. Now, how are the markets assessing this? Because this is hugely important. And the way that the markets react to this is by looking at what is the risk associated with not getting paid. In other words, if I'm going to lend you my money, what's the risk associated with that? And the signal that the market is sending is in something called yield, or interest rates that a borrower has to pay to borrow money. And when the U.S. government wanted to borrow money for 10 years, not too long ago, that was about 4.6%. It's lower now, but just at that moment in time, it was 4.6%. And what matters is that at that moment in time, not too long ago, it was 4.6. And then as you look around, the U.S. government is not the only entity that wants to borrow money. Apple also wants to borrow money, and they have the same 10-year bonds, and Apple would love to pay 4.6%, but the market's saying not so fast, not so
Right.
fast. You know, you need to pay us a little bit more because I think the perceived risk of not getting paid from you is greater. And then you can go the line. Another great American company, Ford, they can borrow money, but they have to pay an even higher rate as a perception that from a risk perspective, they're not as solid as Apple. And you go to Nordstrom, I mean, we're all shop there, and it's still like they want to borrow money, it's higher. So to me, the signal that we look at as investors is, what is the relative interest rate of the US government to other borrowers? And what we're seeing right now is clearly around the world, the US government bonds are considered to be the safest. It might not be perfect, but on a relative basis, it has not lost that status. And if the markets are starting to
But you're comparing it to other dollar denominated bonds, right?
correct, correct. This is all
If you
dollar to
started
dollar.
to print money and then you factored in an expectation of inflation, wouldn't that affect the required return on all four of those examples in a similar
Absolutely.
way?
So absolutely, well, that one is a big one. The expectation of inflation is a big driver, and that's why when you look at these numbers, these are from about a year ago. Today, the expectation of inflation has dropped, and one of the reasons that one of the consequences of that is that also that rate has dropped. So absolutely, but once they move, the whole question is on a relative basis. So I don't even care what the actual level is, but on a relative basis, who pays more? And whether you look right now, whether you look in the a year ago, it's the relative basis that pretty much stayed the same. The U.S. rates are relatively lower to everybody else, and that's kind of what we're looking at. The actual level changes with inflation, changes with market dynamics, but it's the relative level that hasn't changed. And what's also interesting is that if the market gets a hold of the fact that you might not be able to repay, like it was the case with Argentina, well, boy, that's going to manifest in the borrowing cost. The yields on these Argentinian bonds at the same time, they skyrocketed just to reflect that the concern that investors have that their debt is not sustainable. And I think that's what I really want to emphasize, is that the signal that the market is sending is one in which investors are not just blabbering with their mouth, but they're voting. They're voting with billions and billions of dollars in the way that they accept interest rates. The government cannot force any of us to give money or to enter into this contract. If I feel like I'm not compensated commensurate to the risk, I'm not going to give them the money. I'm going to go give it to Apple or give it to somebody else. And that's the signal that we're seeing right now, is that even though it's not perfect, the investors still absolutely have a belief that the government is a better bet than anybody else out there. And as you said, well put. This is, I'm comparing apples with apples, denominated in dollars rather than euros or something else.
Okay. Someone just sent me a question. If I could ask, I don't think
Absolutely.
you can see this on your screen. I can see it here. This is a local person. Notes that China recently liquidated a large holding of U.S. debt, partly as retaliation against U.S. policy on Taiwan. I was always under the impression that China's liquidation of debt would devastate U.S. markets. Are you aware of that? Do you share that concern? Is that something that was on your radar?
Yeah, so the liquidation of the debt. So there are two things here. So the Chinese, whether it's government or banks, they decided to lend money to the U.S. government, and they bought these bonds. So now they have these bonds, and these bonds entitle them to receive interest payments from the U.S. government. Now they can take these bonds and say, I'm going to hold them, and I get the money that I was promised, or I can go and sell them. The thing that's interesting is that there is no evidence that the Chinese are basically flooding the U.S. market with their bonds. There would be huge news. And the trouble is that if you start flooding a lot of the markets with these bonds, the problem is that you're shooting yourself in the foot big time. Big time. If you're trying to dump a lot of bonds at the same time you try to sell them, the market gets a hold of them. Well, the price will tank because they see a huge dump of bonds. The price would tanks, and what those Chinese would get in return would be huge losses. And I'm not, I don't think they're foolish enough to do anything like that. So there is no evidence of that happening. The Chinese are not really the largest holders of U.S. debt. I mean, the Japanese hold more U.S. debt. You have the Treasury, you have institutions. So the Chinese, in the big scheme, they're not really as big of a holders of U.S. debt. They might hold other things, like they might hold mortgage-backed securities and so forth, but not necessarily government debt. And then they would have to say, okay, now that I liquidated this, I took the losses, what are they going to do with their money? Where are they going to invest it to have that same safety that they desire? They're going to keep it in cash. They're losing money at that point. Why would they do that? So no, I don't see any evidence of that. And I think economically, I would have a hard time thinking that they're just really going to shoot themselves in the foot and hurt their own citizens, for that matter. And no, I think that's more of a narrative that might exist in certain parts of the media. I don't see that in the data.
Okay. So we're right at 4:45. Do you have any? This is a good conversation, and I enjoyed it. I had some questions, and you answered many of them before I even got to a point to ask. Are there any other wrap-up thoughts that you'd like to conclude with?
Yeah, I mean, I'll wrap up with we have a presidential election. I think so many people are caught up with this idea that a president might help or hurt the stock market, and I want to kind of go back to the data very quickly to kind of wrap up this whole thing. Yeah. In my lifetime, born in 1969, the average growth per year in the stock market has been about 10% per year. That's the average annualized return in the market per year. And the question is, if you look at different presidents, different policies, do you see that average during their tenure in the White House being higher or lower because of the policies, because of being Republican or Democrat? And then when I was born in 69, President Nixon was in the White House, and the average per year actually was negative 2.9%. The market lost 2.9% per year instead of growing for 5.5 years. And then his vice president, Jerry Ford, came along, the market skyrockets at 20%. And then if you go through the different presidents, President Carter for one term, President Reagan, President George H.W. Bush, and then Bill Clinton, President George W. Bush, President Obama, and President Trump. Listen, if you look at the numbers, just look at the numbers. And I've asked this question of audiences across the country and the world, whether or not it's obvious that having a Republican or a Democrat is better or worse for the markets. And the reality is that there is no obvious pattern. And it's to me, it's not even fair to assign blame or credit, because we talked earlier about policies. George H.W. Bush cut taxes to dividends and capital gains specifically to investments. And yet the market dropped 4% per year. So you can say he was not a good president for the markets, even though he cut taxes specifically to investing. And yet, he came in just as the dot-com was going bust, something he had nothing to do with. 9/11 happened 9 months into his term, and he walked off at the very bottom of the financial crisis. So should he get blamed for that and said he was not a good president for the market? Not at all. And then you had President Clinton, who came in just as the dot-com was taken off. And I'm not sure the White House had much to do with Pest.com and Amazon and all the companies that power the 90s. And he left before the market turned, so he had a very high average. So I don't believe that you should necessarily look at necessarily a president and say that's going to drive the market. Even take Reagan, President Reagan, great policies towards taxation and business, and the market responded. For 8 years, it went up an average by 15.8%. And a lot of folks,
that's per year, right? That's per year, 15.8%.
Per year, 15%. All of these are per year.
Yeah.
Thank you for clarifying. During the 8 years that he was in the White House. And a few years ago, people were concerned that if we have a socialist coming in the White House, things are going to be terrible, and we should sell and move to Canada. And there was a concern that this president is not focused on business, but much more on healthcare for the country and social programs. And they're afraid that the markets are not going to do well. And if you look at the 8 years of the Obama administration, the markets on average went up by 16%, pretty much the same. So whether you had a president focused on business, one on social programs and healthcare, the markets didn't really look at it and say, aha, So the ultimate test to me has been, though, not just the presidents, but what if you include Congress? And 3 years ago, there was an election in Georgia where the two Democrats won the Senate races. And at that point, the Democrats controlled the White House, the Senate and the House. And 3 years ago, I thought, well, that's the most natural experiment, not to split hairs between they control this and not that. I don't have any, but rather, what if one party controls everything? You have this unified government control when you control the White House, the Senate, and the House at the same time. And when you look back at the data in the S&P 500, going back to 1920s, the Republicans had this unified government control for 13 years. And in those 13 years, on average, a simple average, the market went up by 14.52%. And then during the same 90 plus years, the Democrats also had this unified government control, single party control, but not 13 years, but rather 34 years, so quite a bit longer. So the question is, how do the markets do then? And back 3 years ago, when I ran this analysis, I realized, boy, this is a very touchy number, because somebody might say that I'm trying to promote one party or whatever. No, this is just numbers talking. And we had the research group and the PhDs double check the numbers. And it turns out that during the 34 years of the Democratic unified government control, the markets went up by 14.52%. It is identical to the second decimal. It's crazy. And to me, it's contrary to what people want to believe. They want to believe that that one party is better or worse. That's just not what the data suggests. So the ultimate conclusion is that in any way you parse the data, in any way you look at it in an objective fashion, what you see is that politics and election is certainly a variable that impacts the market. It just tends to be one of the many variables that impact the profits of a company, and it's not a primary one. And to me, the way I all tied it up together was not too long ago when I was baking cookies with my daughter, and you put in the sugar, the flour, the eggs, the butter, you mix it all in, you pop it in the oven. When the cookie's baked and you break it apart, there's no way that you can point and say, aha, I see the egg yolk in there. No, you can't. It's mixed in with so many ingredients that it becomes indistinguishable. Mm-hmm. And to me, that's what politics is. It's the egg yolk in a cookie, that it's there somewhere. You can't really distinguish it. And the good news is not the garlic in a cookie. Doesn't stink it up that you can recognize it. But rather, it's just one of the many variables. And because it's not a primary variable, I do believe that investors are better off sticking with the plan that Eric has provided for you, and not make emotional decisions with your money, because they're pretty much emotional. There's no data to suggest that one should buy or sell based on anything that's going on in elections and politics.
Yeah, thank you. And that was a great way to wrap this up with those two charts. The specific examples of market returns when Reagan was president compared to market returns when Obama was president. And then also comparing it to the periods of time that the Democrats controlled the White House and both chambers of Congress, to periods that the Republicans controlled the government. Those are two very good graphical illustrations. So I want to thank you. I think we can wrap it up now. I would say to the folks in the audience that if you enjoyed this program, this was a first, kind of an experiment for me. But if you did enjoy it, please send me an email and give me some feedback, because we can do more of these in the future. And if I don't get any emails, I'll be hurt, but I'll take it. No. But if you could give some feedback that will influence my decisions on doing things like this again in the future. So thank you, Apollo. Thanks to everybody who connected with us today, and have a safe evening, and we'll see you next time.
Bye-bye.